You are listening to Investing Matters, brought to you in association with London South East. This is the show that provides informative, educational and entertaining content from the world of investing. We do not give advice, so please do your own research.
Hello and welcome to this Investing Matters podcast. My name is Peter Higgins and you can find me at Conkers3 on Twitter. On this episode of the Investing Matters podcast, I have the delight and honour to speak with the investor, mentor, keynote speaker, business development guru, multi-award winning fund manager, and global best-selling author of by far one of the best investing trading books, The Art of Execution: How the World's Best Investors Get It Wrong and Still Make Millions. Here I am with the global investment thought leader, Lee Freeman-Shor. Lee, welcome.
Oh, thank you for having me, Peter.
Thank you for coming on to this with me, Lee. Now, I know that lots of people are interested in the essence of the book, but I want them first to find out about the essence of Lee Freeman-Shor, okay? So what I want to start with, Lee, is the conversation about the goals and the career ambitions that you had when you embarked on your law degree. We're going that far back, yes, Gary.
Oh
So Nottingham Trent University in 1995.
Wow. I don't know. I had goals or ambitions back then. I mean, it's I left school, wanted to be a chef. That's probably not what you wanted to hear. And I spent a couple of years at catering college, training to be a chef, and while I was there, I did some real-world chefing. You know, worked at various places. Even cooked for these. Cilla Black had this dating show on TV a long time ago. So she came to one of the places I worked at. I cooked. Anyway, long story short, I hated the reality of being a chef. Long hours, unsociable hours. You know, pay not great. And then sort of like, so you know, imagine left school, went into that, and then sort of 8.5 hours myself going, oh, I should have just carried on doing my A-levels. So went back, did my A-levels, then my A-levels, didn't have a clue what to do, but I got good A-levels. Also, I did A-level law back there as well as a few psychology and computer science. And I kind of liked law back then, so I thought, well, I'd do law. I mean, the career advisor suggested it'd be a good option, and you can tell I didn't have a clue what I was going to do there. And so I did law, and I hated law. So
these things, yeah.
I don't know what to say, but the good thing about law is at the end of the first year of my law degree, I tried to change the psychology, and the dean of the law school wouldn't let me, which is fortunate because in the second year I met my wife, who I'm still with, 30 years later. So there's a reason for doing law. It was to meet my wife. She went into law. I definitely didn't. And then from that path, it was kind of just, I guess, unplanned serendipity. Kind of, I left. I qualified to be a IFA back in the late 90s. And it was, as an IFA, I liked the investment side of things. I was an IFA where they sort of they specialized in sort of investments for high net worth individuals, where there's a lot of tax considerations and things. And that's where I got sort of exposed to investing. And from there, I kind of just did a few sideward steps and ended up sort of completely by fluke and luck and chance going into fund management, which I've done a few talks at schools where kids sort of ask, if I want to be a fund manager or an analyst or work in a city and manage billions like you did, what degrees do I have to do? What's the path? They think it's sort of like just a linear path. And I sort of say, well, I'm not sure I'm the right guy to ask because I just kind of fell into it. In fact, when I look at my colleagues, there was only a couple that had that sort of route of sort of going, something like an economics degree and then MBA and then, managing money. Whereas, there's another guy with a law degree, another guy with a geography degree. But that's how I ended up, so kind of weird, serendipitous, unplanned career.
and a fantastic career at that. So we're starting here now by fluke, by serendipity, March 2000, you get that first break, the AXA window. How does that break come about? What were you doing? How many times did you apply? What happened?
Oh, so I was, prior to that, I was working as, for an IFA on the investment side of things. And I was young, and to be successful in that game, you need capital. Because you need to do your own marketing, run your own, you're running your own business, right? And I wasn't born with a silver spoon in my mouth. I didn't have a lot of money, so so I saw a lot of my friends racking up large quantities of debt to try to build out their business, and I wasn't keen on that. So I thought I better get a job, if go on the payroll as opposed to. So then I kind of interviewed with them for a role which was investment development manager, which basically is a guy that hits the road with the sales guys to do seminars on investing, to teach about investment principles. You sit with the investment desk that are running the money, and you sit down with the marketing team and help them do all the marketing and material like that. So when I was doing that at Winterthur, I got involved with the investment committee there who were running the money. So I wasn't running money or doing any analysis per se, but I got involved quite heavily with them, because you're going and hitting the road, telling people what they're investing in, how they're investing, what they're doing, and all this stuff. And then while I was doing that, I got, headhunted by Schroders. So Schroders had seen me on the road, because obviously I'm doing seminars, and they'd seen me on various seminars I'd done with their guys, and they asked me to join them and do a similar thing for their investment desk. And I got a bit more involved in things again there. And then, again, this is where it's serendipity. I end up, my old boss from Winterthur had become CIO of Scandia, investment management, as it was called back there. And I wasn't particularly happy at Schroders, and we kept in touch. And he said, "Look, why don't you come and join me again, and this time get involved in doing actual, get back on the investment research side, and maybe you run money as well." So he opened the door, and I went, and that's kind of how it started. Then start doing you're learning how to do proper research, if you like, and then then it sort of goes into running money, and the rest is history, I guess. So you can kind of see a lot of jumping around, and on the job learning and having. I mean, my old boss, he was a proper mentor. He was very good. He was, he obviously saw something in me. Thought, you've obviously got the ability to do the research and the investing, and he gave me that break. And sometimes that's what happens in life. So I'm very thankful for Tom.
Absolutely. So some breaks and some luck and some fluke, but also it's about having the quality that you clearly showed to be headhunted in the first place by Schroders, but then the former manager to say, absolutely, we need this individual at Scandia. So from there, you go in, you're doing various different roles, but then you become the fund manager of what, for all intents and purposes, is a more than $1 billion best ideas fund range. Is that correct?
Yeah. So I sort of started off doing various research in European equities and US equities, and started managing a few funds in those arenas. And then I ended up managing a range of funds called Best Ideas. And there were 4 of them: a global fund, a European fund, a UK and a UK long short. And later during my evolution, I also managed 6 other funds, which were multi-asset. So I managed a couple of billion in the end, but effectively it was the Best Ideas funds, which sort of I feel like I started off on. I did manage some funds before those, but they were the ones that kind of I got reputation for, which the findings of the book is based on.
Brilliant. Now, with regards to, I'm trying to discompass this because obviously you're doing a wide range of funds, but I'm pretty sure that you had an investment research strategy / philosophy to encompass you actually gaining access to those best ideas then? What was it then? We're talking 2005 to 12. What was your research strategy supposed to be around that time?
So the genesis of the Best Ideas Funds is there was back at the time there was a lot of focus on alpha to outperform, generating excess terms, get a bit technical. And a few people were kicking around the idea, wouldn't it be great if we could create a fund whereby we got a team of the best investors in the world. We just asked them to invest in their 10 best ideas to make money. Now that sounds very simple, and it in all intents and purposes it is. But there's a lot of academic reasons why you'd want to do that. For example, there's a white paper written in 2004 called Best Ideas by professors at London School of Economics and Harvard, where they showed that if you look at active fund managers, the bulk of their returns come from a handful of their highest conviction names. So to me, my research, I was sort of heading research then as well, I look at something like that and that translates to, okay, you've got a fund where the fund managers own, say, 50 stocks or 100 stocks. It's telling you that 45 of those 50 are a waste of time, or 90 of the 100 are a complete waste of time. And we know, reality as a former fund manager, I can be honest and say it's true, because most of that is just padding, filling, risk control. It's not about making money; it's about protecting your ass and not getting fired, and and all that stuff. So you sort of go, okay, wouldn't it be good if we can get some really good managers and just get them to invest in their 10 best ideas to make money, and then there's this academic research supports it. And then we sort of go, okay, it'd be even better if we could really let them dial into those names. So we so in my European Best Ideas Fund, I was managing the overall fund, but it's me and a bunch of 9 other investors at the beginning. And we're all investing in 10 stocks. But I said, wouldn't it be great if we could invest up to 25% in a single idea? So we could really back our highest conviction ideas, which again is a mathematical principle called Kelly criterion, which, if you want to compound your money as fast as possible, that's kind of what you do. And we thought about this, kicked it around, then we approached these great investors and to see if they'd be up for it, because you're talking about guys that are very successful, some billionaires, some close to money, and they loved the idea. They said, "My God, this is what I want to do," because in their funds they're quite constrained by various risk controls and regulatory parameters and stuff. So that was surprising. They were all on board, and we're able to create these funds where I kind of, back in the day, used to do a presentation with a football slide, like a Real Madrid football team, and just go, here we've got the best idea, we've got the best investors investing in their best ideas. This fund should be fantastic. And, it worked. So that was the genesis, simple idea, simple concept, but it's backed in quite a lot of academic research behind it. But I could bore you, but I won't bore you because your listeners are
Please continue. No, but I mean, the fantastic thing about it is, you say it sounds simple, but it's very, very complicated, right? And with doing that, you were essentially recognized, I'm going to read it as it says here, recognized as one of the world's top fund managers in the inaugural Citywire 1000 report for that Scandia Best Ideas Funds. So globally, everyone was going, we need to be tracking what this young man, as he were then, and still are now, was doing.
Yeah. I mean, it worked. It got traction. We got recognition. The European Best Ideas Fund, as when I got recognized in that, it was one of the best funds in Europe. It's nice. It's very nice when you have an idea, a theory, you put it together and it works. It's pretty pleasing, not as young as I used to be anymore,
Bizarre, mate. Bizarre. So what happens next then? You're doing extremely well. You've been globally recognized at Scandia. What leads to the move to Old Mutual Global Investors then, Lee, in June 2012? We're now, 12 years on. Yeah,
that's Old Mutual and Scandia merged. So it wasn't a move, it was more a merger. And, with the merger, subsequently it led to me managing more money. So, for example, I used to only manage equities, so global, Europe and UK. And then when we merged with Old Mutual, they had a fund manager on their side, a bond fund manager called Stuart Cowley, very famous bond fund manager actually. He retired, and then he handed over his it's like a fund of fund, multi-asset fund of fund. He handed that over to me and a colleague to manage, and that was my first exposure, if you like, to running. Even though I sat on a multi-asset desk, and it was first for me to have my name on one of those funds running them. And then from that, subsequently, I got given other multi-asset funds, another global fund to manage. So, I had my Global Best Ideas Fund was about, half a billion in size. And then I got given another global fund, which was $1 billion sterling in size to manage. So, from the merger, good things happen for me in terms of responsibility, but, workload goes up, pressure goes up, and yeah.
Absolutely. So I want to talk about some of the things that you did during that time, where you presented, who you were speaking with, the accolades that you got as well during that time, because it was a significant time. You're managing several multi-billions now, and you're still absolutely, to use my term, smashing it out of the park regarding results and success.
Yeah, no, as you alluded to, it was good. Getting recognition from the agencies and the various groups, obviously winning mandates and investors. So, yeah, I mean, I don't know what to say, really. It's nice when that happens.
No, you did fantastically well. Now, one of the things you've not touched on here, and I will touch on it, you've got this mandate, you've got all this money to manage. One of the fundamental difficulties of any fund management role is managing money. But then you've also got to manage the fund managers internally and externally that are managing your money. You know what I mean? And so on and so forth. So tell us a bit about that. And then this is the precursor to actually the research that led to you writing your fantastic global successful book.
Okay. So the way the funds were, the technical name is manager of manager funds, because as you said, you're managing other fund managers. The way you do that is obviously within your fund, because they're managing a part of your fund. You can see a bit like a bank manager. You can see their account in your fund. You can see what shares they're investing in. You can see how much money they're making or losing. You can see what they're buying, what they're selling. So it's almost, even if they're not in-house. Now, some of the investors were in-house with me in the same company, but obviously others are in the USA or Japan or wherever they're based, in Europe, France. But the fact that you've got complete visibility on their account and what they're trading in, what they're investing and stuff, you can have conversations with them almost like you're sitting across from you, because I'll be looking at what they're buying and selling, and then if I'm curious about something or I don't like something, I would just pick up the phone and say, "Hey, I'll give you an example. I won't mention the name, but if you go back to 2009, the global financial crisis in 2008, stock markets collapsed, get cremated. It looks like the world's ending. Banks have been hammered." And then in February 2009, I can always remember, I went to my desk, fired up the trading screens, and I saw one of my investors had put a big position in Barclays Bank. And my initial thought was, which idiot, which fool has bought Barclays Bank at this point? But and then I saw who had bought it, and I was like, oh, he's quite smart actually. But this was also, the thing was, this was also a guy that I knew. When I saw that, I was like, hold on, he's short in his hedge funds, he's short banks, what's going on here? So I rang him up and go, what's going on? He's like, yes, no. And he's like, yeah, I think, I've made long money on the shorts, now I'm closing, now I'm going long, because I think, looking at what's happening, we're going to make, next 12 months, it's up 500%. So, the guy was phenomenal. Well, interestingly is, he had a hit rate of, only 3 out of 10 of his names made money. But when he made money, he knocked them out of the park. And when he lost, he didn't lose too much. I mean, that was how fantastic he was. But I can always remember that because, it's just like, but that's, hopefully that gives you an insight into how I manage them, because you can see and you have complete visibility on what they're buying and selling. It's almost as if I've put the trades on my desk myself. Obviously I was putting my own trades on my desk, but they're sitting wherever they're sitting in the world putting their trades on. But because it's within my funds, I can see right through and see what they're buying and selling, which allows me to manage the managers, to your point. And obviously that's important, because if you see things you don't like and you're having conversations, like any manager, you have to fire the people that aren't performing or aren't doing things what you would expect them to be doing, if you're not happy. But as again, go back to the football analogy, it's a bit like being Alex Ferguson at Man United. If David Beckham wasn't playing well, you sub him and put someone else on. That's probably showing my age now, because that's like 1990s football team.
You talk about personalities here, aren't you, and skill sets, and the fact that you saw in this particular individual someone you thought, who's doing that? And then you think, oh, it's him that's doing it, or hers that's doing it. And then you find out they're being very contrarian after being contrarian before, going short. Now they're going long. You're thinking, let me just give them a little bit of leg room here to see how well they do. And then they've gone and smashed it out of the park. So absolutely phenomenal. And that takes a lot of experience to be able to work out the good ones and the bad ones. And as you say, you're filtering out the bad ones as well all along. So Lee, here we are. In a nutshell, you're managing a team of over 40 of the world's leading investors, right? And the book we're talking about now is essentially you talking about their skill sets, their winning habits of these elite investors. And you introduce the world to the assassins, the hunters, the rabbits, connoisseurs, and the raiders, okay? So I'm just going to give everyone a little bit of background here regarding the book, numbers-wise. Over 7 years, 40 to 45 of the world's top investors were given $25 to $150 million to invest by you, Lee. Your instructions were simple. There was only one rule. They could only invest in their top 10 best ideas, or best 10 ideas. And from 2006 to 2013, you examined all 1,866 investments and a remarkable 30,000, if I get this right, and 84 trades.
Yeah.
Some number. You must love research, I'll tell you that. And what surprised you was that only 49% of these investments made money, while some of the most legendary investors of these top investors only made money 30% of the time. Yeah, almost all of them did not lose money. Let's take it from there then. Let's talk about the 5 distinct tribes, categories, and the investing styles, execution behavior regarding losing and profitable positions. You're talking about all those 5 now: assassins, hunters, rabbits, connoisseurs, and raiders. Where do you start, Lee? Do you want to start with rabbits and their execution style and why they get it wrong all the time? And people on FinTwit and on X, they talk about, when they talk about rabbits, they call them Peter rabbits, which I think is a bit of an insult to me as well.
But I have to speak to the publisher, see if I could change it. And rename it Peter Rabbit. So those tribes, those 5 tribes you mentioned, three of those belong. So I always think about, what I discovered is the great investors have habits of execution. And it's the way they behave when they're losing and when they're winning that matters. Okay, so the idea itself, it kind of, it's a toss of a coin whether it makes money. So what matters is what do you do when you're losing, what do you do when you're winning. So when you're losing, I found that the investors would turn into one of 3 types of being. They'd either become a rabbit, they'd either become an assassin, or they'd become a hunter. So if you're losing, you fall into one of those 3 tribes. Now, the rabbit, as you alluded to, this is an investor is losing money, and a bit like I call it a rabbit because it's basically, he does nothing. And a rabbit's a good analogy because, you think of a rabbit on the road and a car's coming at them 100 miles an hour with the lights on at night time, and they just freeze from fear. They just freeze, don't move, and the car, smash, they're dead. And also, rabbit's a good analogy because rabbits dig holes and they keep digging and digging, and these guys were digging holes that were too deep they couldn't get out of. So there, that you don't want to be a rabbit, because I put some numbers on why you don't want to be a rabbit, because these are guys that lost me a lot of money and I had to fire them. But I took analyzing all those trades to work out what was going wrong, and that it was basically, it's when they're losing, that's where things are going pear-shaped. And people don't realize that if you're down 50%, you've got to make 100% just to get back to where you started. People, non-mathematical people think you're down 50, you need 50 to get back to where you started. No, you're down 50, you need to make 100% just to get back where you were. And then it gets, and if you're down 75%, you need to make 300% to get back to where you were. And if you're down 90%, well, you need to make 900% just to get back to where you were. So basically, that's the problem with rabbits. The losses they'd be losing, and they'd be losing 10, 20, 30, 40, and then it gets, to a magnitude whereby they're doing nothing. They're not prepared to sell, and they're not prepared to throw more money at the idea, which is what you need to do in that scenario. And they just sit there, and it was clear to me that they were wrong. Either the idea was wrong, or the timing was wrong, or both. And they just were unprepared to admit one or both things. Because, I'd have some bizarre discussions where they'd talk about how fantastic this idea was, how they'd pound the desk telling me how amazing, how they still believe. And then I'd go, okay. It's down 75%. You've done it. So if it's so great, it's 75% cheaper today, why haven't you, literally thrown the kitchen sink at it? Where your behavior doesn't marry and match up with what you're telling me. And obviously, you can imagine they'd always have some excuse to, at the time I'm just waiting, trying to finesse things, or I'm meeting the chairman next week or some. And I had enough excuses which I catalogue in the book. But it's anyway. So you don't want to be a rabbit, because basically doing nothing when you're losing is a losing trait. So if you want to be a really bad investor, go ahead, do nothing when you're losing. You're going to be a terrible investor. So the advice is to be either an assassin or a hunter. So if I flip now to an assassin, as the name alludes to, is someone that when they're losing, they just kill the losing position. The no emotion about it, no crying. They're down 20%. They just sell, get out, move on. Live another day kind of mentality. And the good, and obviously, when you do that, because you're limiting your losses, you don't have to make that much money back to get back to where you started. That's the key thing from a compounding point of view. It's you've lost some money, but it's not too bad. Move on to a new idea. You can make it up quick. You can make it up. And so people that were willing to do that when they were losing, they proved to be really successful investors. The ones that had that kind of approach when they find themselves losing. Hunters were more rare. There were only a few. I didn't have so many hunters, but they were probably amongst the best when they did it. But they were the ones that, when they found themselves losing and they got down maybe 25, 30%, they would double up, triple up. They'd have no problem, throwing the kitchen sink at an idea that was losing. So that's different from a rabbit, because a rabbit would do nothing. And if I'll just bring it to life in terms of just simple, I'll give you an example, like simple mathematics as to why it makes sense. So if you and I invested in, I don't know, British American tobacco or something, and we invested at the same time, and we're down, but we had one difference between you and I, Pete. So that is, we have £1,000, right? Day one, you put all £1,000 in, and because I'm a rabbit, that influences my position sizing when I first invest. So I'm going to go, okay, I know I'm probably wrong in my timing of this, but I've got quite a high conviction in my idea. So I went for £1,000 in day one. I put £500 day one. So we got in there. Now imagine, roll forward a few months, and you and I found ourselves down 25%. The difference is I'm actually a hunter. So as a hunter, I can then go, yeah, I knew that kind of happened. So no problem. I'm going to throw my other £500 at that idea now. You can't do that because you've deployed all your capital. The interesting thing from that point of view, from that perspective is at that point in time, you're down 25%, I'm down 12.5% because I held back, some of my capital. And, but the guys I was with, they were doing that obviously with a lot bigger number. They were £10 million every time or £5 million every time. And you've got to have a strong constitution emotionally to be able to handle throwing that much money in ideas and see it not work. It's I can tell you it's very, very uncomfortable. I mean, I within my own pot of money, I was adopting a rabbit approach whereby sorry, not a rabbit approach, a hunter approach whereby I would basically adopt what I called a 3-bullet strategy, and we developed this trading tool which was called Wingman, which I created with the quant analysts built it for me because I'm not quant, I'm not a math genius. I told them what I want and everything they created it for me, and it's called Wingman because I'm an 80s child in terms of I think of Top Gun, and I think every great pilot needs a wingman to be successful. So this trading tool was designed to tell me when to take action and remove the emotion out of it. So this thing would be, if I'd invested in like that analogy we got there, what would happen is you're down 25%. I would then get an email from my quant analyst, Sarah, telling me you got to do something. It's down 25%. At the same, she used to sit opposite me as well, so she'd also stick her head above the computer, say, "Hey, not great news. This is down. It's hit. It's down 25%. And then she'd go, okay, you're at the one bullet mark, because in that analogy earlier, I mean, imagine you had that £1,000 a game, where you divide it into three lots of 333, so I've thrown 333 pounds at it, and then I get this trigger come up, and then I go, oh, you're like, oh, that sucks. Oh, well, part of the plan, let's deploy bullet number 2. So I'll throw another 333 pounds at it. And then you're hoping you really don't get to the third bullet. I mean, it happened a couple of times, and that I can tell you, with the numbers I was obviously playing with, 5-10 million a time, and then it means your position is huge. It's 20-30 million or whatever it is. Then you're beginning to feel very uncomfortable because on the third bullet you've already lost a lot of money, and now you're committing more capital to an idea where you've either got the idea really wrong or you got your timing really wrong, and it's very, very uncomfortable. But usually, when by doing that, often it works out, and you actually, these things turn around, you make money. But but there's the three, the if you like, the 3 tribes when you're losing. Don't be a rabbit, unless you want to be a terrible investor. Be either an assassin or a hunter, and that which one you choose to be, an assassin or a hunter, will really, I think, it depends on your personality and your emotional makeup, because as you probably alluded to, taking a loss can be hard enough. I mean, that sucks because you kind of go, oh, God, I've lost this and walked away. But when you're a hunter and you're losing, that loss can become bigger and bigger, and it may not turn around. And that requires, that is, from my personal experience, I found that a lot more difficult to do, even with the help of a trading system that was telling me, do it, and trying to, the emotions are still there. And I dare say if I wasn't applying the findings from my book and I didn't have this trading tool, I might fall in the trap of most investors going, oh, I think I'll just watch and see how this plays out, or I just pretend it's not happening and go down the pub or something. But then obviously clearly you're turning into a rabbit, which would be terrible. So hence why we had the Wingman system, was designed to force action, because that's what great investors do. When you're losing, you don't sit there and do nothing. You take action, you take material action.
You spoke about the rabbits and the hunters there, and also with the Wingman. And you touched on it a little bit there, but I want to ask this question a bit more, to elicit a bit more out of you. Why is it, do you think, and also the psychological flaw, that investors don't seek out opposing views so that they can then make that decision a bit more clinically regarding getting out, or, as you say, averaging down regarding a certain position? Does that help sometimes?
Yeah, what you're saying is what should happen. And I think the problem with professional investors there's lots of biases they, like all of us, we fall prey to. But I think particularly professional investors, overconfidence bias is massive. I'm right. Who are you to tell me I'm wrong, Peter? Yeah, that kind of thing. I've done my research. What does that muppet know? I know more than the market. I've done, So I think a lot of professional investors fall foul of overconfidence bias, and then when you're losing, there's another bias called confirmation bias, which is you tend to look for evidence that supports your. Instead of doing what you said, which is the correct thing to do, seek out opposing views and challenge your model. A lot of people actually seek out views which confirm what they're doing. And that's confirmation bias. And then it's lots of other things, which is, if you look at when you're losing, you suffer from endowment bias, which means someone that, and I used to love endowment bias because I used to have fun with the managers with this one. Probably shouldn't say this, but it's maybe a bit.
Don, we say.
I used to like it because you could see and then the way they're suffering from it. So endowment bias is basically when you own something, you value it more than if you didn't own it. So it's a bit like if you had a watch that had sentimental value to you, and say when you bought it was £1,000, but in today's market it's £10, right? And I say to you, Peter, I'll buy that off you for £10. You'd go, bugger off. It cost me £1,000, and that's anchoring bias, where you're anchoring to the initial price. So that's another thing that messes people over. It cost me £1,000, and no, it's sentimental. So actually, maybe you'd want more than £1,000, maybe you want £2,000, or at least you'd want more than £10, and you'll be unwilling to sell because you've got this endowment effect, and then when you're the way I'd know someone's suffering from what again related sunk cost bias is when you're losing, it impacts you as well. But I would say to one of my investors, I had a really good. This is a real story I'll tell you here, but it's I had an investor that had invested in Superdry, Supergroup. So
yes.
The Superdry Supergroup. So and when that was down about 35% or whatever, and I'm looking at trades, so I'm ringing you up saying, okay, what are you going to do? Because as you can probably tell, I'm not going to have any rabbits on my team. So it's, you haven't done anything. You're down 35. What are you going to do? What are you doing? And he's like, well, I got this literally. So I'm meeting the chairman in 2 weeks' time, and I think my thesis is still true, and I think it's going to be good when the next quarter's earnings come out, all this stuff. And I said, okay, that's great. What are you going to do today? What are you going to do right now? And he's like, well, I'm not going to do anything right now. Tell me. And I said, okay, hold on. So I said, look, if you're not going to do anything, I'm going to do something. I'm going to fire you. And he said, well, don't be like that. Let's talk about it. And he said, I know. Let's meet at the Arts Club. Now, for those who aren't in London and don't know the Arts Club, it's a very posh, swish, members-only club, which I couldn't even get in. You have to be a certain billionaire and various statues. You have to, it's a who's who kind of place. So I go there with him, and we're drinking some wine, and he's telling me the story. And at the end of it, I just say, and he's telling me why it's the great investment. So at the end of all this, I just say, okay, so when I go to my desk tomorrow, what am I going to see you do? What are you going to do? And he goes, seriously? And I said, yes. I said, given what you said, I would expect you're going to load up on it and add more. And he's like, okay. Next day he sold.
There you go.
Now, the interesting point there is, because I gave him the blank piece of paper test, which I always said, if I was giving you the money today, right now, and you didn't have that position, would you buy it today? And he went, no, I wouldn't. And that's classic, where you realize endowment bias, anchoring, sunken cost bias, disposition effect, all these behavioral biases people can look up on the internet was impacting this. Then this is a legendary hedge fund investor, phenomenal. And then anyway, it's the right thing to do because the stock kept going like this. To his credit, a few months later he bought back in it, and then it went up a lot. So it's quite good. I limited the losses on the downside, and he went in later, and he made X months down the line and made money. But that's kind of hopefully gives you a feel for what goes on in people's mind. Even, these are guys who've been running money for 20, 30 years, legends. You'll always fall into traps when you've got a high conviction idea isn't working. All these biases kind of screw you over.
Absolutely. But this just shows and reiterates with your point there brilliantly that no one's immune, no matter how experienced, how much money they're running.
That's true.
So heaven help us, lowly little retail investors. Yeah, real investors. So I'm going to talk a little bit now about the assassins. I mean, you've got a bit of a polish on and a liking for assassin. Everybody wants to be a connoisseur, but let's talk about those and their traits, what they do better, and what they don't do so well, please.
So assassins, as we spoke earlier, I mean, they're the guys that when they're losing, they just cut a loss at about, say 20% and just move on. I mean, my research in the book I share is, you don't want to cut your losses too soon. Like, it depends on your own approach. But I mean, from what I was doing, I tended to find people that cut their losses at 10% or less tend to have got whipsawed, as in, they get out and then the shares boom back up. And because that's just, a lot of times that's just volatility. That's just natural share price volatility. But obviously what you do in those circumstances depends on your position. If you're a futures trader with lots of leverage, then you're going to get killed if you go down 10%. So, you've got to know what you're doing, really. But assassins would basically, they just have an approach, which is, if I'm wrong, I'm getting out, I'm moving on. And going back to your point earlier, I mean, if you have that approach, you can be wrong most of the time. Like, you can be wrong 70% of the time and still make a lot of money, because when you're losing, you're only losing a small amount of money every time. But the important thing is, if you're going to be a successful assassin, you need to be, and this is on the winning side now, you need to have the habit of being a connoisseur, the trait of being a connoisseur. What does that mean? In simple terms, ride your winners. Because what you need to happen is you need to have a couple of big winners. They will make all the difference, because they offset all those losses you have. So any investment approach has to have you have to embrace the possibility of winning big. And what stops you from winning big, which I became to really not like, and didn't have investors that did this, but price targets. Price targets are bad. I'll tell you why. Because if you invest in something for £1 today and you say, okay, I've got a price target of £1.20, and then it goes to £1.20. Well, great. But you've made 20%, but that's not going to offset all the losses you've got. And you need to admit. So I'll just flip it to connoisseur because it's important. If you're an assassin, you also need to be a connoisseur. And I'll give you an example. I will use something topical like Bitcoin. Just go a bit of fun. What not to do as a successful investor, full stop, but especially if you're an assassin. So you imagine you and I, Peter, went into Bitcoin in 2016 when it was £300 for a single Bitcoin, right? And let's imagine you and I buy 10 of them. So we both invested £3,000 in 2016, got 10 Bitcoins, £300 each. Now, at the end of 2016, Bitcoin was over £600 a coin. Now, what you don't want to do is you don't want to be a raider. Now, a raider, let's assume you're the, you can play the bad guy here, Peter. You're going to be the raider here. So you're a raider and you go, great, my Bitcoin, I bought it at £300 of Bitcoin, now it's £600 of Bitcoin. My £3,000, because I bought 10 of them, my £3,000 is now worth £6,000. I'm selling, right? So you can imagine, end of 2016, you've sold, you've made £3,000 profit, you're down the pub, you're celebrating Christmas, everyone's happy, you're buying rounds, you're thinking, God, I'm a genius. Whoa, this is great. Now, that would kind of suck and be the wrong thing to do if you want to be a professional investor, if you want to be a successful investor. Now imagine, let's just to really ram this home. Now imagine you and I meet today, and I go, hey Peter, so happy we bought those Bitcoins, and you go, yeah. I say to you, yeah, I can't believe it's made a real. I mean, I've been able to retire because of the money I've made. I mean, you go, what? And I go, what? You mean you're not still holding them, Peter? You've sold your Bitcoin. You go, well, yeah, I made 100% in 2016. I made £3,000. I go, oh, I say, well, today they're worth £52,000 for a single coin. So whereas you made £3,000, I've made £520,000. Now, at that point, you'd probably want to puke. You'd probably want to hit me. You'd probably scream. You'd probably have a temper tantrum like a 2-year-old. I mean, I definitely would. I'd have all those things. I'd be crying my eyes out. I don't know. But that's kind of, that's important. So when you're winning, if you find yourself in a position where you're winning, you've got to be prepared to try to ride the winner. Taking 20% profit, 10% profit, that's what the guys who are really bad investors did for me. And the problem there obviously is if you're limiting your winnings all the time to 10 or 20%, the problem is on the losing side, you're always going to get some big losers. You're always going to lose 50% here, 70% there, whatever. So that's you're shooting yourself in the foot. So the assassin, hopefully you can see, you can to be a successful assassin where you can lose most of the time and still make money. That's only because on the winning side of the ledger, when you're winning, you have to be a connoisseur. And if you're not a connoisseur, but you're an assassin, it's not going to work. Yeah. So you need to, that's why I split the book into habits when you're winning and habits when you're losing. And you really need to find yourself when you're losing, being an assassin or a hunter. And when you're winning, you've got one choice, which is be a connoisseur, ride your winner, basically. And there's things you can do to help you ride your winner, like, take some money off the top, be trimming it. So you're, in that example, instead of you selling your Bitcoin in 2016, you go, oh, I doubled my money. Maybe I'll take 1,000 or 2,000 off the table or something like that, and just keep some going in there. That helps helps with that riding the winner without it affecting you too bad mentally, because you have all the ups and downs. And the worst thing you can do with take Bitcoin as an example, if you're in it, as I do, one point it went from right up to 50, 60,000, right back down to 10,000. At that point you think, oh my God, I should have sold it back then. But it's taking a bit off the top when you're winning helps ride a winner. And a raider, I guess
to seamlessly to what essentially the raiders, they just nip in, do what they need to do. They've got discipline. And I want to talk specifically in your book, Lee, because you gave a brilliant example of an execution style of a raider. And one such raider had a 70% success hit rate. But it's fair to say not exactly the best outperformer of the cohort either, but a 70% hit rate was staggering.
Yeah, this is the point. So you could, if you're a raider, effectively, you could be in a position where you have a high hit rate, so i.e. lots of your ideas you're making money in. But if on the other side of the ledger, when you're losing, you're a rabbit and you have a couple of big winners, your overall performance could be terrible or even loss-making. So it's, generally, if your hit rate's high enough and you're not a muppet on the loop, if you're not a rabbit on the other side, you'll be fine. But most people, as you saw, the whole point of the book is most people's hit rates is around 50%. Toss of a coin, which that's why I wrote the books. It blew my mind. I'd hired the best investors in the world, said just invest in your best ideas, and it's a toss of a coin as to whether their ideas made money. I thought that was unbelievable. So I think any investor assuming they're going to have a high hit rate and therefore they can be like a raider, which is a losing style, which is just take 10% here, 20% there. I think that's a very dangerous mindset. Very few investors I came across had high hit rates.
Now let's get to the winners. Let's talk about the connoisseurs, their mindset, Lee, what they did differently, the level of research they did, and also about how successful they were in a sense of staying humble even when they were winning. And I want to talk about the boredom factor that you touched on as well once you've gone through this.
Yeah. Well, it's boring being a connoisseur.
Nice.
Yeah, well, the point there, let's flip it back to the Bitcoin analogy. If you're holding something for a long time and not trading, it gets a bit boring because people are itching to do something, right? They're always looking at new ideas, new things to invest in, and being in the same thing all the time, it gets very boring because there's nothing new. It's the same story as to why in it. It's boring. But connoisseurs, basically, I think these are people clearly that they had a strong, like all these ideas, strong fundamental reasons to why they're in it. They could see that, or believe that in the future, obviously, it's going to go up more, and just were prepared to ride it. But I would actually say, because I spoke to some traders about this. If you look at very successful trend following traders as a flip side of it, because traders tend to have a shorter. If you look at those, a lot of them have a view which is, I don't know where things are going, up or down, left or right. I don't know, but all I do is I buy the trend, I follow the trend, right? And the key point about the guys I had and those guys is both of those approaches have an open-ended approach to winning, which is they're not capping their winners. They're not saying, if it gets this price target, I'm out. They're not saying, I bought this on 10 times earnings, and when it gets to 15 times earnings, I'm out. Yeah, which is a valuation case for selling. In fact, I mean, a lot of the really bad investors obviously had price targets which limited the upside, or they had a valuation case which limited the upside. Which it's very dangerous, because when you're doing that, you buy something because it's cheap, and then the reason you got it is because it's cheap, and now it gets to what you consider fair value, and then you sell. Oftentimes, it's surprising how the share price will keep on going up and up and up and up and up, because the reason it was cheap has now gone. And but for value investors, that's where they often hurt themselves, in that they get out things too soon. And by a lot of value investors, by the very nature of things, they tend to be buying things contrarian when things go the wrong way. So you're probably going to get a few big losers. So you really have to have an approach whereby you can win big. So connoisseurs, in general, I would say they were very emotionally mature. They're fine being bored with an idea. They didn't, volatility along the way. They kind of knew how to handle that, as they trim some weights off and stuff. They would and they'd respect them. I guess that's the other thing. They respect the market, because they know things can go a lot further than you can possibly imagine. So why limit the upside by putting into place arbitrary price targets, etc., that mean something to you but not to the rest of the market? I mean, imagine something like, we talk Nvidia, because that's another topical thing. If you're big into AI, and you go buy Nvidia. Now, if you bought Nvidia if you're a connoisseur, you'd have bought Nvidia in 2019 for about $4, right? And if you're a connoisseur, you have that AI. This is a play on AI, and this is it. You'd probably still be riding it today. And today it's what, $131? So you've made a lot of money, and if you're a raider, which is what you don't want to be, you'd have probably gone, some point during that ride, you'd have got off. You'd have got off because you've turned $4 into $8 or $12 or $4 into $100. Whatever, you'd have got off ages ago, and you wouldn't have made all that upside. So it's handling your emotions is very important, I think. And don't put things in your way that are going to cause you to do the wrong thing when you're winning.
Absolutely. One of the points that you made, though, Lee, in the book, is about the connoisseur's approach, in the sense of seeking out those very best ideas that he or she can hold for 10 or more years. And there just seems to be an approach for most investors now where they become very short-termist. And, most research is showing that a long-term investor or a medium-term investor is holding a stock for 6 months, maybe less than 6 months, rather than 10 years.
Yeah, no, it's a problem. I mean, high turnover like that generally doesn't bode well if you want to be a successful investor, because by definition, what's the chance of you or I making a hell of a lot of money in 6 months? I mean, it's you could get lucky. You could have got on Nvidia at the right time when it goes up like that, or Bitcoin when it's gone flying or something. But generally, in 6 months, you make money over time and compounding, right? I mean, that's the key. And And yeah, the guys I had in my team were all obviously active investors or fundamental investors who had done a lot of work on their ideas. And, if their idea worked, then it makes sense that it's going to be a multi-year holding period. They weren't looking at the share price. They didn't have a trading mentality, which is it's a pound today, and I think it's going to be £2 in 6 months, and then I'll get out. No. They were looking at the fundamental story, the earnings, the valuation side of things, and if their thesis played out, it was clear that they could be in it for. There was one guy. I mean, when you talk about boredom factor, I mean, he's now retired, but he was in the same name for as long as I knew him. And that 20 years in the same, and it was, and he made a fortune in this now. He actually made a killing in this name. And I'd see it in other investors' portfolios. It'd pop up and it'd go away, pop up and it'd go away. Whenever it comes vogue or fashionable, they'd go in and come out. But because he understood the company, he understood what they did, he could see the story, see where it's going. Over his period of time, he made a frightening amount of money in that name. I mean, thousands and thousands of percent. But to do that, I think a lot of people find it tough because they're always looking, to your point, looking for action. They want to sit at the desk every day. What do I want to buy? What do I want to sell? They want to trade. They want to, go into your desk and just looking at your names and just going, yeah, there they are. Same names as they were 5 years ago. Yeah. I think, it's kind of,
Now, on that note, then you've got that individual that's in that position, is he or she's held it for a significantly long time and compounding it significantly over many, many years. How does one deal with that as a fund manager regarding the position sizing of that? Because if you've got 10 ideas in that portfolio, that multi-bagger, you're trying to cultivate, your book is advocating cultivating multi-baggers. That position goes from a 3% position, maybe, or a 5% position, to now 15, 20, 25. How does one cope with that oversized position, or should cope with that position?
Yeah, so the ones I had, they would be what we talked about, taking money off the table. So basically, as it's going up and up, they're very cognizant and aware of to your point, risk and position sizing in the overall frame of things. And and obviously they couldn't have more than 25% in an individual name for me as well, because that's quite a lot of capital to put at risk. So they'd just be, to your point, if it was 5%, they went to 10%, they'd maybe go, okay, let's just take it down to 8%. That's what they'd do. They'd all the time just make sure that overall that single idea didn't become the be all and end all. Because if you didn't think about position, position sizing is important because it allows you to do everything you need. Position sizing is not. A lot of people don't pay enough attention to position sizing because, to your point, if you had let a position go 5, 10, 15, 20, 50% of your portfolio, at some point you got one idea is going to determine your future, right? You made a lot of money, but then if it turns, you could really kill yourself and be out of business and lose all your money. Yeah. So you always have to be aware of position size. That's why. So, for example, if a lot of the hunters I had these are guys that were prepared to throw a lot more money at an idea when they were losing, because they knew that at outset their position size would be a lot smaller. So instead of putting say I don't know 10% in the beginning, they put 5%. Yeah, because they'd know that basically, okay, I've got my other bit sitting in cash over here or in another investment, and then if I need to take it up to 10%, I will do when it's losing. Also, liquidity is another thing which is probably worth mentioning because, if you let your position get, as a professional investor, when you're running billions, if you let your position get too far out of hand, you're going to have a liquidity problem. You won't be able to buy where you need to buy. You won't be able to sell where you need to sell, and that can be that can prevent you executing as you want, even if you want to do that. This is where you sort of lessons learned category, but in the early days of Best Ideas, we had one investor that went into some, let's call them, micro cap. They weren't even small cap. They were small names. And then obviously had 2008 happen. And then at that time, he did disastrously. We fired him, but then you actually could not sell his shares. There's no market, no liquidity. This is the problem. You don't want to find yourself in illiquid shares. You end up having to do a risk trade where someone says, "Okay, I'll take those off your hand for 50% less than what the current price is." And that's horrible to happen. But so to your point, yeah, you got to think about position size that's not so big that it dwarfs everything, and the whole of your investment life and your wealth depends on that one single trade, and that's important. I mean, so yeah, most of my guys, their initial position sizing was 5 to 10%, which is big. In terms of in today's fund management world, it's most positions are 1%, 2%. Maybe the really aggressive ones would be 5%. But for me, they could go up to 25%. But most day one would go in at 5 or 10%. Being aware of the risk, liquidity, etc., things that you've got to be cognizant of. It's very dangerous to just have a massive. I mean, if you have a massive position, and then sod's law happens, and some news flow comes out, and the share's down 70% the next day. I mean, if you're down 75%, you need 300% to get back to where you started, and then it becomes 300% for your whole portfolio, not just that single name in the portfolio. So you've got a problem.
Absolutely. Now, I'm conscious of the time, so I've got to ask you these questions very, very quickly, Lee, because you are, I will say, a professor of investing, but obviously you're an expert. So I want to talk a little bit about your own personal money's investment philosophy, strategy, and also about the geographical spread maybe that you've got in your portfolio, because you're so well traveled, you see a lot of things happening, and you do a lot of research. Your connoisseur mindset regarding your own monies, please.
So the nice thing is that, having stepped back from being a fund manager and just focus on your own money, which is a nice position to be in. I do things outside of the stock market, which whether it's art or gold or things like this. But in terms of investments, in terms of my investment portfolio, I mean, you'll find that it's kind of long-standing exposures. That if I talk about my pension fund, I tend to have entrusted that to guys that are still running money instead of me being bothered to do that, which is I think is nice. It means I know the guys, I know trust them. In terms of my own, my investment account that I play around with, I mean that basically you'll find things. I mean I'm very aware of saying what ideas I'm in, just because the whole thrust of my book is it's the execution of the idea that matters, not the idea itself. And a lot of people, they hear an idea from an investor and then they'll go, all right, I need to go out and buy that, and I think that's quite dangerous. So. For
more of the diversity of the assets in the sense of small cap, mid caps, US tech, biotech.
Yeah, it's kind of diverse. I've got physical gold, I've got gold miners, I've got uranium exposures, I've got S&P 500. ETFs. I've it's eclectic. I would say. I mean, just to bring it to life, the gold position I've had that on since 2016.
Brilliant.
So I mean, that's that's doubled in it's up over 100% over that time period, which relative to being in the S&P 500 or Nasdaq or Nvidia is pretty crap. But in terms of, my own money, I just want to make money. I don't, but that's gold. Gold serves a purpose for me in my portfolios in terms of there's a thesis I have as to why I think it should do well, but also there's, it's a hedge if everything does go pear-shaped, hopefully it has a store of value. And obviously other things like, quite boring, but it's like, the S&P 500 is just, it's easy. You just, you can trade, you can say not trade around it, but basically in terms of my wing, so I the wingman tool that I developed when I was running money, I've obviously now in my own personal account, I've adapted and changed it a bit, but it's, but basically I have that trading. The key thing is when I go into it, I have the trading system still there, which tells me anything I go into, my outset is basically, it's going to be a toss of a coin whether I make money. I'm not a genius. I'm not an investment guru. The guys I work with were geniuses, were investment gurus, and they were still a toss of a coin whether they made money. So whatever I go in, as I said to you, S&P dog, whatever, I always think, right, I don't know if he's going to make money, 50%. There are some things that I'm prepared to be a hunter in. So something like S&P 500, over the long term, it benefited you to at certain, if you get a drawdown of 25, 30%, whatever, to throw more money at it, right? So with something like that, I'm adopting a hunting approach where if it comes off, it comes off. If it comes off by a certain amount, 25 to 35%, I'll be throwing more money at it, right? But things which are a bit more spicy and risky, like some of the mining exposures I've got, which are leveraged, operating and financial leverage to the underlying asset, they're quite spicy and people, there's a lot of speculation in that market as well. So with those things, when they come off, I'm an assassin. So if that comes off, I'm at each point I'm out because I'm aware of why I'm in it. I know who plays in those markets. So in my own personal book of money, it's I'm the stuff I'm trading with. I'm basically some things I'm a hunter, some things I'm an assassin. When I'm losing. I'm all the time a connoisseur. So if something's winning, I'm just leaving it. I mean, hopefully that example of the gold will give you an example of that. I just let it run out and that's kind of the way I do it. And then, as I say, because of my background of being a manager of managers, I know there's some fantastic investors out there, and I'd be a bit arrogant to say, hey, I should just manage all my money because I'm so good. No. So with my longer term money, my pension money, I'm nearly 50. With my pension money, I just entrust, because that's so long, I just entrust that to guys I've known for a long time, and I have it with them. So yeah, that's kind of what I do with my nowadays.
I'm conscious of the time, Lee, so I've got two questions I'm going to ask you. I'm going to be cheeky with one of them. You've had some time off now. You've studied Kabbalah, which is its tradition is a way to peace consists of shifting our divisive nature of love to love and connection above our difference, etc. You've done a master's degree, psychology and neuroscience of mental health as well. And you got a distinction, so kudos to you for that. But I'm going to ask a cheeky question and say, look, you've had all this time off. Surely there's a follow-up book coming to The Art of Execution, and if so, when?
You've been speaking to my publisher.
Actually, your wife's asked this question as well.
Yeah. The ironic thing is, Peter, when I stepped back from running money in 2018, I thought I'm going to have my son's bar mitzvah year, and I thought I'm just going to take a time off, do some traveling, just enjoy life a bit. Yeah. And I did that, and that was great. And then I got a bit bored. Bored is probably the wrong approach, but I need to be doing things. And so I started having an attempt to write the follow-up to this book, because the publisher, Harriman House, has been successful. It's in Stash bestsellers in China, etc. And I tried to write a follow-up to it, and I spent a lot of time on it, and I just couldn't get happy with it, right? So then I thought, all right, this was 2019. This was, and I thought, I thought, well, I've always been interested in psychology and neuroscience, and when things go wrong mentally, I'm always interested when things go wrong. So I did that degree at King's College and did well. And I learned more about, obviously, the mind, how it works, and obviously all that kind of stuff, which I think is good for investing as well. Absolutely. And then after that, I've never walked away from investing or even the book idea. And It's funny you say that, because right now, as I speak, I'm writing the follow-up to the book. Learn it, and that's because over the years I have engaged back and forth with a publisher, and they've given me some ideas about what they would want to see and what would like to see, and as I speak today, I'm literally writing the follow-up book, and I've got the manuscript has to be in by the end of this year, and if everything goes to plan, it'll be summer, July, August, September next year, it'll be out. So it won't be ready to publish for a year or time, but it's happening now, and yes, I mean, it's like you say, I've had enough time to play around with other things. Now, I mean, and the book the follow-up needs to be written because, as you probably imagine, I've had a lot of people asking various questions and on various aspects of it, which warrant a deeper dive into some areas. And so I'm working on that as a work in progress. So yeah, don't know what it's going to be called, but it's happening.
Well, we don't need to know what it's called yet. But that's absolutely phenomenal news, and I will really look forward to purchasing that when it arrives next year. Thank you ever so much for sharing that news. And it's an exclusive for our listeners as well, globally, so thank you very much. Right.
No problem.
I've got one final question. I'm going to read this to you, Lee. Please can you reiterate to our Investing Matters global audience, please, your winner's checklist. What is that list? And really, really being disciplined as investors to be the best that we can possibly be. What is the winner's checklist, please, Lee?
Right. So the winner's checklist is 5, I guess, principles or, things that you should, if you want to be a successful investor, do these 5 things basically. So one is invest only in your best ideas. Logic behind that should make sense because to be a successful investor, you need 1 or 2 of your ideas to win big. So you need to go for whatever your best ideas are that can potentially win massive, win big. They're what you want to go for. The second one is position size matters. And we talked about position size earlier, how, it is important, the size of your position, whether it's liquidity, whatever reasons. But so think about position size when you go in. It does allow you to play games when you're losing. And when you're winning, it doesn't present you with what you said, a headache of a position becoming too big that you've got problems on that side of the ledger as well. So position size matters. The third one was be greedy when winning. Again, can't emphasize that enough. I mean, if I was to rip out 2 or 3 of the big winners from any of my team's investments, their returns would be mediocre. I mean, 1 or 2 big winners makes all the difference. So, be greedy when winning. The fourth one was materially adapt when losing, and that's important. So don't be a rabbit. When you're losing, do something and do something big. So either cut the loser, walk away, be an assassin, or throw a lot more money at it, which is being a hunter. So, and then the final point related to all this is only invest in liquid stocks. Now, obviously I think the last point is more addressed to professional investors, I think, or people with a lot of money where, liquidity becomes a problem. But, always consider liquidity in a name because it's nothing worse than wanting to sell and you can't sell, or wanting to buy and you can't buy. That's a terrible situation to be in. And so that's the winner's checklist. There's 5 things.
Fantastic. And that last one you said about liquidity also impacts even those on the FTSE and AIM sometimes when they've got a large position and they can't sell out of it. You've got to ring up, rather than just doing it online. So, and they tell you they still can't do it. It's been absolutely amazing to speak with you. It's been an absolute joy. You've just cascaded all that information off the top of your head there. I know you're a thought leader and you speak all the time at seminars, but what you've shared with us today has been fantastic. And thank you ever so much for talking and sharing the insights that you had regarding a fund manager and sharing the insights regarding your fantastic book, The Art of Execution, which I absolutely recommend everyone to get because they're going to need to have read that before they buy the next book as well. So, Lee, thank you ever so much, sir, for being on this Investing Matters podcast with me. And I very much look forward to speaking to you, hopefully, sometime next year as well.
Thank you very much, Peter. Thank you. And when the book comes out, I'll definitely send you a copy.
Oh, that's very kind of you, Lee. So kind of you. Thank you, sir. Thank you. Take care. God bless you, sir.
You take care, John. Bye-bye.
Thank you for taking the time to listen to Investing Matters. Be sure to check out the London South East website for free tools and info to research your next investment. You can also join in the conversation on our social media channels. And don't forget to subscribe to our YouTube channel for more content, including our CEO interviews. Catch you next time.